What's up, trader? In most of my analysis, probably you have seen that I'm talking about the liquidity grab. Liquidity grab. What is that liquidity grab in fact? So in this video, I will show you everything you need to understand about liquidity grab. Once you understand it, you can grab the biggest trade possible in the market, because once the price grab liquidity, it has a fresh and new momentum that push the price with a high speed. And at the same time, I will show you what is the theory behind liquidity grab, what are the signs that you should look for to understand which one is a liquidity grab and how you can trade them in the first place. Sound interesting? Then smash the like button, hit the subscribe button if you haven't done yet. This is Forex Wizard from Forex Trading Wizard Academy. With that being said, let's get started. Okay guys and girls, so let's understand the theory behind the liquidity grab. What is the theory behind, and then we'll look for all the signs and symptoms, and then we'll look at the chart how you can identify and trade the liquidity grab to grab the biggest trade possible. Now first of all, let's consider an ideal scenario. On the chart you can see that let's say there is a double bottom here. Okay, the price has created this double bottom, and then the price has broken out of it, started an uptrending market, right, and moving in a channel. So this is a channel. The price was moving, creating a higher high and higher low, moving in an uptrending market. Now the question is why the price moves like this, creating a higher high and higher low. The reason is, let's say the big boys want to buy from here. This is an order block zone. You can see the video I will link about the order block. So this is an order block zone. Let's say big boys want to buy $200 billion as an example, or $200 million, whatever. Okay, so they want to buy from here, but they cannot buy with all this money at a time. Okay, what will happen if they buy? The price will go like skyrocket. So what will happen? They need to invest some money. Let's say maybe $10 million or $1 billion. The price will go there, and then they will take profit, will come back here, and again they will invest some more. The price will go up, and again they will take profit, will come back. That's where the price moves, right? Now at some point, let's say when the price was here, okay, now they cannot buy anymore, okay, because the price is too high. Keep in mind that in the market, if someone want to buy, they need a seller, right? It's a transaction between buyers and sellers. So when the price is too high, okay, there is no seller, right? So if they want to buy, they need a seller. Now what happened is that when they are buying everywhere, like retail trader like you and me, and even the institutional trader buying with them, right, at a time. So when, let's say, you and me bought from here, okay, with them, we see that, okay, they are buying, creating a series of higher high and higher low. Let's buy from here with them. Now when you buy from here, where is your stop loss? Below this level, right? Below this zone. This is where your stop loss. Now keep in mind that when you buy, your stop loss is basically a sell order. Keep in mind. So once you put your stop loss here and you bought from here, what happened? The price went there, and then because there is not enough liquidity for them to push the price higher, they sell either by manipulation, which some people call it manipulation or false breakout. They sell so that the price come here, because there is a lot of stop loss here. There's a lot of buyers bought from here, many places. They put their stop loss in this zone. This is called a liquidity zone. That means that there is a lot of stop loss. When they push the price, let's say they invested, for example, could be that they invested $100 million to sell, to push the price here, right? Now once the price is here, automatically there is a lot of stop loss hit. All the buyers are turned into a seller, and that is the liquidity. So once they got this order, sell order, they got the seller, then they buy from here again. So the price came down, now it's a lower price, they buy and they make money from this market. That's called the manipulation or whatever you say, but this is the normal phenomena in the market, that buyers forced to become a seller, and that is called liquidity gap. Now the question is, why it is so important for you to know? The reason is, when you see a liquidity gap, that's a sign of bigger move. The reason is, when you see the trend was going up, right, creating a series of higher high and higher low, it's an uptrend. Now the trend is tired now, right? At some point buyers are tired, so when they grab liquidity, there is a lot of buyers starting to sell. The trend has a new life, it's a fresh, new, refreshed trend. Okay, and that is why from here buying is so profitable. And when you see this kind of liquidity grab, you can prepare for a bigger move and you can catch that trade to make the bigger profit from the market. Now the question is, how do you know that it's a liquidity gap? Let's look at now some signs that you can look for. It's not exact, but in most cases you can find a clue using these signs and symptoms that it could be a liquidity gap, but you need to wait for the liquidity gap to be completed, and then I'll tell you how you can trade this kind of liquidity gap. Okay, so now let's look at the signs that how you can understand it could be a liquidity gap, but we will wait for the confirmation. But first of all, some signs that you can look for that can give you an idea that it could be a liquidity gap, but you still need to observe. So the first sign of liquidity gap is breakout in the opposite direction of the trend or channel. This is the most important sign of liquidity gap. So what do I mean by this? Let's say the price was moving along this channel, right, like this, creating a series of higher high and higher low. So as a rule of thumb, the price should break out to the direction of the trend, because it's an uptrend, right? So as a rule of thumb, the price should break out to the other, in the direction of the trend. But suddenly, if you see that the price has broken opposite direction of the trend without any warning, with a bigger candle, that could be a sign of liquidity gap, not confirmed yet, you need to wait. The second sign is breakout without reversal pattern. So what do I mean by this? Let's say when you see the price is breaking out from this channel, normally it creates a reversal pattern. Let's say it might create a double top here and then break out and then retest, right? But in case of liquidity gap, you might see a one like this, a one or two vertical candle directly break out in the opposite direction of the trend. That could be a sign of liquidity gap. Now once you saw that liquidity gap, like the price has broken out, which is a liquidity gap, if you realize that, don't jump on a trade, wait for the price to go back to the channel again. So when the price go back to the trend or channel again, then this is a liquidity gap. Okay, this is a confirm, this is a liquidity gap, and that is where you can trade this kind of instrument. Now to trade this liquidity gap, when you see the price has broken out of the channel on the opposite direction or trend and then went back to the channel, after it went back to the channel, you see the price will test the support zone again. Let me clarify it again. Let's say when you see that the price was, let's consider a downward channel like this. Okay, now the price was moving series of lower high and like this. At some point the trend, the price has broken out of this channel on the opposite direction of the trend and then immediately came back down. So that's a liquidity gap, right? Now when you see this kind of situation, you see that after breaking down, this price will go up again to test this zone, okay, this level, and that is where the high probability trades are, and that is what is the perfect place for entry. When you see that liquidity gap happened, the price came back to the range or trend, and then again the price is testing this zone as a resistance, that means that this is a fake move. Okay, there's a lot of stop loss hit, the price has a momentum, it is now respecting this trend line again, and that is what the entry in based on what kind of price action you want to look for. Okay, so that is the main concept behind liquidity grab. Now let's find out in real chart how you can identify a liquidity grab and how you can grab the biggest trade possible in the market. Let's look at it. So let's see this example on Aussie dollar, and we'll replay this chart and we'll see exactly what we are talking about. Now let's replay this chart here. You can see that. Okay, so what you see, look at this here, what happened. The price was respecting this resistance here. You can see this is a clear level of resistance, and with that respect of this resistance, we have seen that suddenly one candle without any warning, okay, without any kind of reversal pattern, suddenly has broken out of the opposite direction of the trend. This is the first clue, as I told you, and without creating any reversal pattern proper. This is the second clue, but it's still not sure. At any point the price could continue to go up. So the next thing you look for is coming back, right? The coming back to the range. Okay, so that, look at it, it's still not there. Let's wait for some time. Now we see that, you can see that what happened, one candle without any warning sign has gone out opposite direction of the trend and then came back down with a bigger candle and inside the range. Okay, so that creating a liquidity grab, but it's still not fully developed. Let's see what happened. You see that the price came back down well below, and then see what happened. This is the most important part that you need to keep in mind in liquidity. You see that this is the most important part. See, when you see that, you see this is the trend line is clearly defined like that. Okay, now you have seen that there is a liquidity grab happen, okay, and the price came back to the range. So when do you enter the trade? When you see that the resistance, this trend line, the top of this trend line, this resistance here, resistance here, resistance here, resistance here. Okay, now after breakdown, what happened? This one, okay, this narrow candle acted this resistance, tested this resistance. Okay, you see that with this doji created a lower high. That means that it basically created this one as a fake move, liquidity grab, and then came back down, tested this one as a resistance and respected. Respected means that this level respected means what is this? It's a fake move, and there is a lot of liquidity, a lot of stop loss hit. All the people who are shorting here, okay, sellers turn into buyer. So when you see this, that means that this trend is basically preparing for a very bigger move. Okay, and see what happened. Let's say you trade this one here. Let's say you can say, okay, I got a liquidity grab and I keep my stop loss above this high, and let's see what happened. Okay, well above the stop loss, and see how much profit you can take from this trade. So until it hits you to stop loss, if you hold the trade, you easily can take almost 6 times profit, 6-to-1 reward to risk ratio trade. Can you imagine? And that is the power of liquidity grab. Let's jump on to more examples so that you can understand this concept and apply in your trading today to make profit from the market. Okay guys, so let's see the same example on British pound US dollar. You can see that the price was creating this downward move here. Let's draw a trend line here, and you can see this is the nice looking downward trend. The price was respecting this resistance. Okay, every time the price was respecting this resistance and creating a series of lower high. Okay, series of lower high, and then the price basically, what happened, look at this, it was respecting this support and the bouncing to this resistance. Okay, creating a lower. Suddenly look at this green candle here. You see one unusual big candle has broken out of this resistance without any warning. Okay, and went above, all of this above, and then what happened, look at this, later immediately the price came back to the range again, to this level of resistance. Okay, now once the price came back to this resistance, okay, what you saw, that look at this, with this red candle, it's a strong breakdown and then came back to the resistance. Okay, now once the price came back to this resistance, we see that this resistance is been respected again. Back to back, two green candle came here, again tested this resistance. You see there is a long wick candle, means it basically respected this resistance multiple times. So that means that this is basically a liquidity gap. And when you see that this resistance is being respected, if you trade from here, let's say above this, if you keep your stop loss above this long wick candle, or even you can keep your stop loss above the liquidity gap, okay, it's a bit bigger, but still you can keep that, and you can still see, even if you enter a trade keeping your stop loss above the liquidity gap, see how much profit you can make from. Can you imagine this trade? Okay, look at the power of this strategy. 13-14 times profit from this single trade. When you trade the liquidity gap, smash the like button now, hit the subscribe button if you haven't done yet. So this is how you will understand liquidity gap. This is how you will grab the biggest trade possible in the market. Let's see some example on the bull market. Okay, so let's see this example on GJ. Okay, you can see that GBP JPY is moving on an uptrend, creating this channel, right? This is a nice looking upward channel. Okay, the first thing that GJ has done, that the price has created this channel. Okay, it's an upward channel. Now what you have seen, that at some point the price has broken down from this channel, right? It's a nice looking breakdown, created a couple of dodges, and with this green candle again the price immediately went back to the range again, okay, creating a liquidity gap or a fake move to the downside. Now with that liquidity gap, what you have seen, that the price again after this, from the top of the channel, the price came back down again to the bottom of the channel, tested this as a support, and then the price started to move up. So when you see this liquidity gap, you know that all the conditions, that opposite direction of the trend, you know that the price again went back to the range and tested the support, the range support, because it's an uptrend, it will test the support. Even if you trade from here, okay, let's say you saw the liquidity gap, you long from here, keeping your stop loss below this low, and then you can make how much profit from this. Can you imagine, guys and girls? Look at this trade. This is the power of this. Even you can go further. See, with that, even the price is with a big gap. Okay, with a big gap, you easily can take at least 5 to 6 times. Okay, how many times? 6 times, almost 6 times profit with such a big gap. Normally we don't keep that much big gap in stop loss. With such a, even if you keep your stop loss, let's say below this neckline of this, you know, couple of dodges, it's a 10 times profit trade. And that's how you can take the biggest trade on the market, by understanding the liquidity gap. I sincerely believe that this valuable lesson was helpful to you. If you find value in this lesson, then don't forget to give a thumbs up, and also don't forget to subscribe to the channel. Thank you for watching. I will see you soon in my next video.